To view the rise and fall of empires through a financial lens is to strip away the romance of conquest and glory and confront a quieter, more decisive force. Because long before an empire collapses on the battlefield, it begins to fracture in its ledgers, its tax systems, its debts, and the invisible contract between the state and those who fund it. Armies march on courage and discipline, but empires endure on surplus, and surplus is always financial before it is military, because an empire is at its core a machine for extracting resources from the present in order to buy stability in the future. When that machine runs smoothly, power feels eternal. When it falters, decline begins, long before historians assign a date to the fall. Every empire rises on a financial innovation, whether deliberate or accidental, that allows it to mobilize resources more effectively than its rivals. In Assyria, it was systematic tribute and centralized plunder. In Persia, it was standardized taxation across vast territories. In Athens, it was silver-backed coinage, paired with imperial tribute. In Rome, it was a sophisticated blend of taxation, land ownership, and monetary circulation that tied distant provinces to the center through obligation rather than proximity. These systems were not neutral technologies. They were expressions of power designed to convert land labor and loyalty into predictable flows of revenue. As long as expansion continued, these flows increased, masking inefficiencies and rewarding elites, and the empire appeared not just strong, but inevitable. But finance has a hidden rhythm that empire builders rarely respect, because extraction scales faster than legitimacy. In the early phases of expansion, conquered territories often produce more wealth than they cost to administer, allowing rulers to lower taxes at home, reward soldiers, and fund monumental projects that reinforce loyalty and awe. This is the golden age when citizens believe the system works, when money feels abundant, and when the state's promises seem credible. Yet beneath this prosperity lies a structural dependency on growth, because the moment expansion slows, the financial logic reverses. Armies still demand pay, infrastructure still requires maintenance, and bureaucracies rarely shrink voluntarily, meaning the empire must extract more from the same population to sustain the same level of power. Rome offers the clearest illustration of this trap. As territorial expansion peaked, the flow of new slaves land, and tribute slowed, but military expenditures continued to rise as borders stretched and threats multiplied. To bridge the gap, the state turned increasingly to financial manipulation, debasing the currency selling offices and relying on tax farmers who extracted aggressively from the provinces. Each of these measures provided short-term relief while eroding long-term trust, because money once diluted carried less meaning, and taxes once perceived as predatory undermined loyalty. Inflation was not merely an economic phenomenon, it was a psychological one, signaling to citizens and soldiers alike that the state was promising more than it could deliver. This pattern repeats across empires with unsettling consistency. In Han China, state monopolies and heavy taxation funded defense and administration, but when fiscal pressure intensified, corruption and rebellion followed. In the Abbasid Caliphate, a once dynamic tax and trade system gradually ossified as military expenses rose, and provincial elites retained revenue locally starving the center. In each case, the problem was not a lack of wealth in absolute terms, but the declining ability of the state to channel that wealth effectively without provoking resistance. Financial systems that once unified the empire became fault lines along which it fractured. What makes imperial decline so difficult to arrest is that financial stress distorts decision-making at the highest levels. Leaders facing revenue shortfalls are incentivized to prioritize immediate survival over structural reform, choosing debasement over discipline, extraction over legitimacy, and coercion over consent. These choices feel rational in the moment because they postpone collapse, but they also accelerate it by hollowing out the very institutions that made the empire viable. Markets respond, prices rise, trade contracts, and capital seeks safety outside the imperial system, leaving the state increasingly isolated from the economic vitality it depends on. The final stage of imperial decline is rarely marked by empty treasuries alone, but by a collapse of belief, because money functions only as long as people accept it as a credible claim on the future. When soldiers doubt they will be paid in real value, when merchants doubt contracts will be honored, and when taxpayers doubt revenues are used for collective benefit, financial compliance gives way to evasion, hoarding, and localism. At this point, fragmentation accelerates. Regions become semi-autonomous, and the empire exists more as a memory of authority than a functioning system. The fall, when it comes, feels sudden only because the financial erosion that caused it was gradual and politically inconvenient to acknowledge. Yet it would be a mistake to see this cycle as purely destructive, because the fall of empires also clears financial space for new systems to emerge. Medieval Europe's fragmented monetary landscape grew out of Rome's collapse. The modern nation-state's fiscal apparatus arose from the failures of feudal finance. Global financial institutions were forged in response to the devastation of world empires and total war. Each collapse redistributes not just power, but financial imagination, forcing societies to rethink how resources should be raised, managed, and legitimized. To understand empires financially, then, is to recognize that their rise is funded optimism, and their fall is accumulated denial. Empires do not die because they run out of money in a simple sense. They die because the cost of maintaining their promises exceeds the willingness of their populations to believe in them. And once that belief breaks, no amount of conquest, repression, or accounting ingenuity can fully restore it. Because trust once spent is the hardest currency to reissue. And it is precisely at the moment when empires attempt to stretch that trust beyond its limits, when debts mount, currencies weaken, and extraction intensifies, that history begins to turn against them. And in the next movement of this story, we must step closer to the modern age to see how these imperial financial patterns resurface in global powers that no longer call themselves empires, but operate under strikingly similar constraints and illusions. Approach the modern age, because although the banners, languages, and institutions have changed, the financial logic of empire has not, and what distinguishes modern global powers from their ancient predecessors is not immunity to decline, but the sophistication with which decline can be delayed, disguised, and distributed. In the early modern period, empires like Spain, the Dutch Republic, and Britain revealed a crucial evolution in imperial finance, the transition from tribute and plunder to debt and capital markets, a shift that allowed states to borrow against the future, rather than rely solely on extraction in the present. This innovation transformed war from a test of immediate resources into a test of creditworthiness, and those who could borrow cheaply could fight longer, build larger navies, and sustain global reach beyond what raw tax revenue would permit. Spain's experience offers a stark lesson in the limits of imperial wealth. Flooded with silver from the Americas, the Spanish crown appeared unimaginably rich, yet repeated defaults in the 16th and 17th centuries exposed the paradox of resource-driven empires, because easy money weakened fiscal discipline, encouraged military overreach, and crowded out domestic productive investment. Silver did not stabilize the empire. It destabilized it, fueling inflation and dependency, while creditors gradually lost confidence in the crown's promises. This was an early warning that financial credibility, not sheer abundance, is the true backbone of imperial power. The Dutch Republic, by contrast, demonstrated the strength of institutional trust. Lacking vast territories or mineral wealth, it built an empire on trade finance and a reputation for honoring debt, creating capital markets that attracted savings from across Europe. The ability to borrow at low cost allowed the Dutch to punch above their weight, but it also tied imperial survival to maintaining confidence, because once rivals like Britain matched and surpassed these financial institutions, Dutch power waned. Here again, decline did not come from military defeat alone, but from the erosion of a financial advantage that had once seemed permanent. Britain refined this model further, constructing a fiscal military state that combined taxation, public debt, and a central bank into a resilient system capable of absorbing shocks. The British Empire did not avoid debt. It institutionalized it, spreading costs across generations and integrating financial markets into the machinery of state power. This allowed Britain to survive wars that would have bankrupted earlier empires, but it also embedded a long-term tension because debt expanded faster than imperial control, and the economic burden of maintaining global dominance eventually collided with political and social limits at home. Decolonization was not merely a moral or political process. It was a financial recalibration, an acknowledgement that the costs of empire increasingly exceeded its returns. In the 20th century, the language of empire faded, but the financial structure endured, particularly in the rise of the United States as a global power. Unlike traditional empires, the U.S. projected influence through monetary dominance trade networks and security guarantees, anchoring the global system to its currency and capital markets. This arrangement provided extraordinary advantages, allowing the U.S. to finance deficits cheaply and export inflation abroad. But it also recreated the ancient imperial dilemma in a modern form, because the ability to borrow without immediate consequence encouraged persistent deficits and deferred adjustment. As in Rome, as in Britain, financial flexibility extended power while quietly accumulating obligations that future generations would have to confront. What history suggests is that modern empires do not fall through conquest alone, but through the gradual misalignment of financial privilege and productive capacity. When consumption outpaces production, when financial claims multiply faster than real output, and when global confidence rests more on habit than performance, the system becomes vulnerable to shocks that reveal its fragility. Crises then serve as accelerants, forcing choices that were long postponed, whether through inflation, restructuring, or a reordering of global power. The financial perspective does not predict an inevitable collapse, but it does strip away comforting illusions, because it shows that no empire, however advanced, escapes the arithmetic of trust, debt, and legitimacy. The tools have changed: derivatives, replacing tribute, and central banks, replacing temples. But the underlying equation remains stubbornly human. Empires rise when they solve the problem of financing collective ambition efficiently and credibly, and they fall when the cost of maintaining that ambition exceeds the willingness of others to fund it. The deeper lesson, then, is not cynicism, but clarity. History does not condemn power, it disciplines it. Financial systems are mirrors that reflect the balance between promise and performance, and when that balance breaks, the mirror cracks. Understanding this pattern allows us to see contemporary geopolitics not as unprecedented chaos, but as a familiar phase in a long cycle, one where choices still matter, where reform is possible, and where decline is not fate, but consequence.